Hello, in today's series, we talk about the latest CDL scandal that became the highlight of Singapore's business headlines recently. Market watchers have observed CDL's share price under intense pressure. The family's disagreement has transformed into a serious corporate governance crisis. So, what really happened at one of Singapore's most prestigious companies? Hello everyone, welcome back to SDA Club, the club for stock trading and analysis. This channel is dedicated to providing you with high quality tutorials, guides and insights that demystify the world of trading. Join us as we will share more trading secrets and valuable insights. To stay updated and be the first to access these valuable resources, hit the subscribe button now. By subscribing, you're opening a door to a world of trading and maximizing your potential for success. Before we dive in, here's a quick disclaimer. The information in this video is for educational purposes only. It's not a call to buy or sell. So, who is CDL? City Developments Limited, or CDL, was founded on September 7, 1963 as a property company, initially starting with 8 employees in Amber Mansions on Orchard Road. When the company first started, it built its first project in Johor Bahru, Malaysia. It was a 200-unit bungalow development called Fresh Breezes, which was completed in 1965. With Fresh Breezes, CDL introduced the concept of a show house as a sales technique, which was believed to be unique in Asia. It allows prospective buyers to preview how a property looks like before buying the property. CDL subsequently built its first Singapore development called City Plaza in Bukit Timah, which was a mixed development project and was completed in 1980. Let us now introduce the founders and management, so that it is easier to understand the context of the saga later in this video. So, who is Hong Leong Group then? Hong Leong Group was founded in 1941 by Kweklengbeng and began its roots as a hardware shop, which then slowly expanded into cement, property development, and later into banking and finance. Hong Leong Group began to invest in CDL in 1969, buying a substantial stake, which allowed them to place 3 directors on CDL's board, when CDL itself was a struggling company. Kweklengbeng, then an executive in Hong Leong Group, also the son of founder Kwek Hong Peng, transformed CDL, turning CDL into a profitable company by strategically diversifying into investment properties. CDL made headlines when it pursued a high-profile acquisition of the iconic Plaza Hotel in New York from Donald Trump in 1995 and subsequently purchased the Copthorne Hotel chain, and in the process grew its hotel empire. CDL's financial performance further skyrocketed in the late 1990s to 2000s as the Singapore economy and property demand grew. This was demonstrated by its rise in stock price to a peak of $16 in 2007. It was during the late 2000s that a new generation of leaders helmed CDL when Kweklengbeng's son Sherman Kwek took over as group's CEO in 2018. Things then started to go south during his leadership, and this led to a boardroom tussle that made its way into the headlines recently. CDL's China expansion through the Sincere Property investment was originally celebrated as a game-changing deal, but then became a financial disaster that rattled the company's core. CDL initially bought a 51% joint controlling stake in Sincere Property for approximately 1.18 billion Singapore dollars in April 2020. Sherman Kwek, the CEO, positioned the Sincere deal as a strategic entry into China's property market early on. The deal expanded CDL's presence from 3 to 18 cities, and the investment offered access to a pipeline of 64 development projects, a portfolio of 27 investment properties, and a substantial land bank of 9.2 million square meters. Notwithstanding that Sincere Property faced major liquidity challenges, the company struggled under China's 3 red lines policy that capped developers' borrowings. CDL then formed a special working group with Deloitte China to improve the liquidity and restructure of loans for Sincere Property, but these efforts showed little progress. The investment deteriorated faster than expected as CDL had to write off 93% of its total investment in Sincere Property. The company reported a massive loss after tax of $2.55 billion for financial year 2020. CDL then had to execute a desperate fire sale exit and sold its stake in Sincere at a huge loss. This financial catastrophe sparked immediate changes within CDL's board. Kweklengbeng, a longtime director and cousin of Executive Chairman Kweklengbeng, quit in October 2020. Kweklengbeng specifically cited disagreements over the Sincere investment. Two other directors resigned by the end of 2020, bringing the total board resignations linked to the Sincere debacle to 3. The situation grew more tense when Sincere Property accused CDL of delaying critical decisions. They claimed that this hurt their chances to raise funds and improve cash flow, but CDL strongly denied these allegations. The story took another turn when CDL revealed Sincere's liquidity issues existed even before their investment. They disclosed that Sincere's growth-focused approach had high gearing even before facing two major challenges: the COVID-19's economic impact and China's unprecedented structural policy changes. News about the Sincere Property investment remains a hot topic in the ongoing power struggle today. Kweklengbeng uses this episode to highlight strategic missteps under his son Sherman's leadership. Soon, things came to light with another important figure in this boardroom tussle. Dr. Catherine Wu now stands as the center of CDL's boardroom drama. Dr. Wu plays a crucial role in the power struggle as a board advisor to Millennium and Copthorne Hotels, a CDL subsidiary. Dr. Wu hails from Taiwan and was just 15 years old when her parents sent her to San Francisco Conservatory of Music in the United States. She subsequently won a scholarship in the United States and enrolled in the Juilliard School in New York for further studies. Dr. Wu obtained a master's degree in piano performance in 1982 and went on to obtain a doctorate from New York University and became an accomplished piano performer. Dr. Wu moved to Singapore after meeting Kweklengbeng at a family gathering in 1992, which she described as similar to a job interview. During the meeting, Kwek quizzed her on politics, economics and music before asking if she would consider relocating. Initially, Dr. Wu researched properties for Kwek and gradually learned about hotel management. Dr. Wu has since become a key figure in the ongoing feud between Kwek and his son Sherman, after the latter called her the primary reason behind the dispute. Dr. Wu works as Chairman Kweklengbeng's personal assistant without being on CDL's payroll. The chairman pays her directly instead of the company, and she acts as his eyes and ears because of his age. The tension peaked in February 2025 when Sherman Kwek openly challenged Dr. Wu's growing influence. He stated that she has been interfering in matters going well beyond her scope at both CDL and MNC hotels. His main concern focused on what he called her enormous influence within the organization. Dr. Wu's relationship with the company then took an unexpected turn when she served as a director at MNC Hotels until January 2024, where the company ended her service. However, she made her way back to MNC's board as an advisor just 7 months later. The situation came to a head on February 21st, 2025, when the board passed two key resolutions about Dr. Wu's position: a motion to end her advisory agreement with MNC's board, and a formal declaration that restricted her power to influence or advise directors, management, and staff at both CDL and MNC groups. Sherman Kwek then stressed that these actions came after legal advice and were needed to protect shareholders' interests, safeguard relevant staff members, restore proper corporate governance, and rebuild accountability within the organization. Sherman Kwek mentioned that earlier attempts to handle Dr. Wu's influence were careful and respectful, as they considered her long relationship with the chairman. However, these diplomatic approaches failed and led to stronger board action. Dr. Wu's role has become a symbol of deeper questions about power and governance at one of Singapore's leading real estate companies. CDL then faced a major crisis on February 7, 2025, as a group of directors pushed through a controversial board restructuring using written resolutions. The restructuring created immediate controversy as they completely bypassed CDL's nomination committee process. The situation grew worse when the board quickly merged the nominating committee with the remuneration committee. Chairman Kweklengbeng strongly opposed this consolidation as he saw it as a power grab, though it was supposedly meant to improve oversight of appointments and compensation. Corporate governance experts have serious doubts about how these appointments happen, as these circumstances appeared to depart from the norm of proper nomination procedures. CDL's governance practices now face intense scrutiny, as this scrutiny feels particularly sharp since CDLs was ranked second in the Singapore Governance and Transparency Index 2024. CDL's board has now split into two camps, the chairman's minority group and the CEO's majority supporters. This split raises questions about how well traditional family businesses governance works in today's corporate world. CDL's ongoing crisis shows how family-owned businesses struggle to adapt to modern corporate governance standards. These companies usually make decisions informally, and family relationships matter more than official procedures. JP Morgan and UOB Kay Hian quickly downgraded CDL stock. The company's latest financial performance has dropped by a lot, with annual profit down 37% to 270 million Singapore dollars, and this fell short of what analysts expected. The market is now spooked with several key issues, such as its property development segment revenue declining substantially, financing costs rising amid global economic uncertainty, project timelines facing construction delays, and global office and REIT markets showing weak performance. CDL, however, still has over 3 billion Singapore dollars in cash reserves, but its net gearing ratio has grown from 61% to 69%. So the board cut the total dividend to 10 cents per share, down from 12 cents in financial year 2023. CDL's falling share prices clearly show investors' anxiety due to the company's uncertain future. However, the company's strong asset foundation and market position point to possible recovery paths if leadership issues resolve quickly. The final outcome will guide how other businesses handle succession planning, corporate governance, and strike a balance between families' interests and shareholder value. This unfolding crisis could redefine standards for family-run public companies in Singapore and beyond. Till then, see you in my next video. Goodbye!